Welcome investors. Fed Chief Jerome Powell holds his press conference where the FOMC committee decides not to raise interest rates. He keeps his cards close but gives us clues into where interest rates are going, the effects of the tight monetary policy has had on the economy and the consumer, and what does this all mean for your money? Let's get into it. But before we do, if you find value from this video, be sure to like the video and subscribe to our page so you can stay ahead of the curve with our weekly market videos. I'm Jake Ackerman, your investment advisor. Let's dive into it. All right, so the FOMC meeting was on Wednesday, and the Fed decided not to raise interest rates. What we need to really understand is that the Fed isn't just going to come out and tell us what they're going to do with interest rates, whether they're going to raise them, when they're going to cut, whether they're going to cut them, until the very moment that they're really going to. They'll leave little breadcrumbs, what they're going to do. So our job as professional investors is to read those breadcrumbs. We have to be preemptive with our decision making, not reactionary, or we're just going to miss out on the opportunities, we're going to miss the bus, or we're going to get stuck on a train that's going over a cliff. So today we're going to spend our time analyzing what Jerome Powell said during the press conference. We're going to try to read the tea leaves on what he's saying so we can make the right decisions with our investments. So we've pulled some of the clips from the Fed meeting that took place this Wednesday. And what we're going to do today is we're going to watch them and analyze exactly what he's saying so we can make the best investment decisions we can going forward. So I'm going to start with the opening clip and his opening remarks to find out, to listen of what he's seeing take place and where we're going with rates right now. Let's take a look.
The FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
Okay, rates unchanged, and they're reducing their securities holding. What does that do? So the Fed has a balance sheet and they purchase assets on the open market. Well, that's what they did during 2020, the COVID pandemic. And what does that do? So they go out on the open market and they buy treasuries. When they buy treasuries, they reduce the supply of treasuries, making the treasuries more valuable. And treasuries are like bonds for the government. Well, they are bonds. They're bonds, T-bills, notes, or bills and notes. So when they go and reduce the supply, it increases the demand, makes them more valuable. So treasury values go up, interest rates come down, making borrowing costs cheaper. And what's happening right now? The exact opposite. They're increasing the supply, and that's why interest rates have been going up, and because the supply has been increasing, thereby bringing the value of the treasuries down. So that's what we're seeing right now. So they're doing two things. They're raising rates, number one, because they have the control to do that, and then reducing the supply of their balance sheet. All have a positive impact on interest rates, making them go higher. Another thing that he stated in that is that we have not felt the full effects of this rate raises. There's lags, but we're seeing some damage taking place. We're seeing the ramifications of the higher interest rates and tighter monetary policy. Okay, let's move on to the next one.
Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
Again, acknowledging these lag effects. Historically, when we see the Federal Reserve raise interest rates, there is a delay before we feel any kind of pain, any kind of negative ramifications. And some positive ramifications, such as inflation coming down. It took time. They started raising rates March 2022. They so far have stopped raising rates June 2023. And the summer is the first time we started seeing inflation start to tick down. And now we're just seeing some damage in some sectors of the economy, specifically manufacturing. We've seen commodities come down earlier this year. So these things take time to play out. Historically, it can take anywhere from 12 to 24 months. We're 17, 18 months into this rate raising cycle. So we still have time. And another thing making this take longer is they printed and increased the money supply greatly. I mean, nearly 40% in a year. It was an historic money supply, money printing that we've seen in a lifetime, in generations. So it's going to take some time. They're acknowledging the fact. That's why they can sit patiently and watch these things take place. Let's move on to the next one.
Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go.
They've made progress, yet they have to keep a potential rate hike on the table. They can't take their foot off the gas pedal. Yes, they've made progress. And we're probably going to continue to see it come down. It's not going to come down in a straight line, but at the same time, we're battling damage to the economy, which is also delayed. So why, they're acknowledging it's coming down, but they're not going to take their foot off the gas pedal, because if they do, that's when things can start to tick back up. Interest rates are preemptive, and they're going to start coming down, thereby making money easier to obtain, and then people go out and start spending more. And that's what they're trying to avoid that. So they have to keep rates high for as long as they possibly can. Monetary policy is restrictive. That means, because how we know that, inflation's coming down and we're seeing economical damage. So that's how they know they're winning. But again, they got to keep interest rates high, because this is a battle that they have to win. Let's move on to the next.
In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
Okay, do you notice a theme in this? Fed Chief Jerome Powell tries to play both sides of the coin here. Through his entire opening monologue, he goes back and forth between the inflation's too high, and there's a long way to go. Yet, we understand there's lags. There is some damage. We're seeing that. There's a fine line that he's trying to balance. He's balancing a tightrope where they can't let their foot off the gas pedal, yet they understand that have not seen the full ramifications from the tight monetary policy, the high interest rates. So, and which side of that coin do you think that they're more fixated on? And I think it's pretty clear that they're more fixated on keeping rates high. They don't need to raise rates anymore, because they're seeing that they are successfully completing their objectives so far. It's going in their direction. But they have to defeat inflation. That's the side that they're leaning on. So even though we're seeing damage, they're going to side with the side of caution to defeat inflation. Okay, so now we're going to move on to the part of the press conference where the reporters got to ask Fed Chief Jerome Powell some questions. We're going to play just a couple of those and talk about them, because we need to understand this a little bit better, just what hand Fed Chief Jerome Powell is trying to play, and acknowledgement, and find out really what's going on and what's going to take place over the course of the next few months here. Because the next few months, they want to keep rates where they are. They want to keep monetary policy tight. And it's really important that they get to this next meeting and rates remain where they are. So let's get into that part, okay?
A quick follow-on to be clear on this. In your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't, or we're not confident that we have.
Did you catch that? We're not confident that we have reached tight monetary policy, yet we're not confident that we haven't. We're playing both sides of the coin, folks, and that's what we're going to expect when we hear from these Fed officials at each one of these press conferences. Their strategy is, before these press conferences, they have other Fed officials go out there and give the market the expectations that they want us to have. They're going to tell us what they're going to do before they actually do it. And markets are going to respond immediately because markets are preemptive before things take place. The better we understand that we need to be preemptive with our actions, not reactionary, understand where things are going, the better investor that we are going to be. This next clip I want to show you is a good one. Here you go.
You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result.
All right, so this clip, the reason I said it was good is because it's insulting. The Fed is not going to be fully honest with us. We have to understand that. When he said this is historic, that this isn't not typical of a rate-raising cycle, that is just not true. That's not true at all. And in the next video that I'm going to pull up on here is a visual of what employment does prior to recession times, prior to rate-raising campaigns, because they all coincide. Rate-raising campaigns are generally followed by a recession. What does unemployment do before a recession? Let's take a look. Okay, so check this chart out here, okay? So this is a potential recession time frame chart, and up here is the inverted yield curve. I'm not going to talk about that during this video. I'm going to focus on here, the unemployment rate. That's in that teal color down here. And these magenta shaded areas are the recessions, all right? Now I'm going to start with the 70s here, leading into the early 80s. Unemployment goes down very fast. It's very low. Unemployment is very low prior to a recession. All right, again here, let's check out the 90s. Very low, and then ticks up right before the recession. Again here in the dot-com bubble, early 2000s, and it repeats again 2007, 2008. Very low prior to the recession. That's normal. So when he goes out and said, this is a historic one, this one's different, just realize that that's Fed talk, and he has to talk up a good economy, has to get people expecting things are good, because their talk is a lot of times a self-fulfilling prophecy. So if he says things are going to get bad, things are definitely going to get bad. And they're not going to be honest with us prior to a recession, or they're not going to tell us until we're in one and things are bad. People feel it. I mean, I talked to some of my business clients, a lot of my small business clients, and they're feeling the pain. They're not hiring. Things are they're tight in the markets right now. So let me pull up these interest rate hikes. What are they followed by? Let's take a quick look. Again, the shaded areas are the recession here, okay? So this one starts in the 50s by macro trends, this chart. And it raising rates, followed by a recession cut. Raising rates, followed by a recession cut. Let's get into the 70s. Raising interest rates, right up here, raising rates, followed by a big cut. Again here, mid-70s, cut. Early 80s, followed by a big cut. The mid-80s, end of 80s, followed by a big cut. In the 90s, same deal, cut, raise, cut. And in 2007, 2008, another cut. So this is not a new playbook. This is a playbook that they've used throughout history. They raise rates to defeat inflation, or they have to because some kind of geopolitical event, high energy prices, so they have to raise rates to stop something. That's a tool that they have. They don't have a lot of tools. They have a couple tools. And one of them is raising interest rates. So that's what we're seeing them do right now, raise interest rates. And they have to keep interest rates high. And then what's going to happen when we start to see the damage? That's when we get the interest rate cut. I'm going to leave you with this last clip by Jerome Powell, and then we'll have one more conversation about this clip to really understand where things are going, how long interest rates are going to remain high. Take a listen.
The best thing we can do for the U.S. is to restore price stability, fully restore price stability, and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
You heard it. Their number one goal is to defeat inflation. They have to defeat inflation. So they're going to keep interest rates, this is what they're going to do. They're going to keep interest rates high for as long as they possibly can, because it is for the good of the U.S. economy, the consumer, the world, their careers, their reputation. They have to keep interest rates high for as long as they possibly can, and they hope there's no damage. That's a hope. But they're going to err on the side of defeating inflation, because once we start to see the damage and a recession takes place or something of that nature, they have another tool to reverse that, and that's cut interest rates. But they're not going to cut interest rates until things are breaking. There's going to be panic in the air. There's going to be pain, and that's what they want to take place. So until we start to see real economic damage, and I think a lot of unemployment, that's when we start to see that cut. And when we get the cut, you got to think of the U.S. economy as a big destroyer ship. It takes a long time to turn. It takes a long time to feel the ramifications of the higher rates. And then when they go to cut rates, it's going to take time to turn back and get back on course. So the longer that they keep interest rates high, the longer the damage. And then when they cut rates, depending on how quickly they do it, that's how much longer it takes to get that ship back on track, back in a positive economy. So that's really what we can expect, that they're going to keep interest rates high. We have to understand that. They're not going to cut until we see damage, because they have to. This is the job that they are set out and they are determined to do. Defeat inflation. We have to expect that. If you find value from this video, please be sure to like the video and subscribe to our channel so you can stay up to date with our weekly market videos. Stay tuned with us next week. We're going to talk about some inflation data, analyze it, find out how the markets are going to respond and react over the next couple months here. And as always, expertise you deserve, experience you can count on.